Hello everyone, welcome to Atomic ACCS exam solving series, and in this video we are going to look at question number 2 from section C of Financial Management pre-mock exam for June 2025 session. Previously we are done with the business finance topic. Now we can see right in front of us the word net present value, so we can see this is coming from the topic investment appraisal. So that is our first major area in the syllabus. Let's just read this thing. Calculate the nominal NPV of the project. Nominal NPV means anything related to inflation or all those things are there. We have to take into consideration. NPV of the project, catch the hatched. Okay. And conjunction, always be careful. And comment on whether the project is financially acceptable. Considering this is for 8 marks, this is a good thing because NPV, we know the general structure. If in case any complication comes up in between also, it's totally fine, because out of the whole structure, if in case one or two mistakes are there, it's totally fine, we'll get it. Plus, and comment means that you're going to either say that it's going to be financially acceptable or not acceptable based on being a positive or negative answer. And we have learned in our classes what is the general conclusion that you can always give, be it positive or negative, and that is going to give you 1 mark out of it. So you have a lot of easy marks also within the section C that you can score, which you might end up not getting because of poor time management if in case you start your exam from section A. This is where, as I told earlier, being prepared with the topics that will definitely come for the exam gives you enough confidence that okay, out of 100 some amount of good marks I've already scored. Now only the remaining I have to score from section A and B to pass this exam. All right. So we know this is the NPV question. Let's start reading the case study. Then on the go, we'll discuss further about what else is there. So, what is this? Come on. Okay. Coral companies engaged in selling computer games in the country of Ireland. Recently, it spent 125,000 on market research to evaluate the possibility of success of its newly developed game called Hatch the Hatched. 125,000 on market research to evaluate the possibility of success, which means it's not yet confirmed it will be successful. Imagine a little, bring some knowledge from FR if you have done it. IAS 38, intangible asset. Whenever expenses are met, I mean, expenses are spent, only if you meet criteria you can capitalize it, or else it is just a expense. Similarly, 125,000 market research, you're just expensing it regardless of whether that project becomes a success or not. So this is not an incremental cost, this is a sunk cost, historic cost. So you don't have to consider it in your NPV calculation. Cool. Encouraged by the results of survey, Coralco has decided to launch the game in the near future. Estimated sales volume are as follows. Quantity in thousands are, okay, 120, 135, 160, 100. 4-year project, this is okay. Current estimated selling price, current means in T0 without inflation, is $35 and is subject to the inflation rate of 6% per annum from the first year onwards. Okay. Variable cost at current prices are estimated at $23 per unit and would increase at the cost inflation rate of 4% per annum from year on. Okay, so sales is there, variable cost is there. Nominal incremental fixed costs are expected to be 750,000 for the year 1, for the year 1 and 2, and 800,000 for year 3 and 4. So we have sales price, we have variable cost, we have fixed cost, and the timeline is 4 years, and we have some inflation to do. Okay. Fixed cost is given at the direct rate, so I don't think we have to apply any inflation rate over here. Initial investment is 3 million, it will be paid immediately, that is in T0. Estimated useful life is 4 years. Okay. Tax allowable depreciation will be 25% on reducing balance method. Okay, normal. Balancing allowance will be available to claim at the end of year 4, normal. Project will have a zero realizable value at the end of 4-year period, so no scrap value. Coral company pays tax at 25%, and the tax liability settled in the year in which it arises. So it's not a arrear tax, it is a normal tax. That is also normal. Everything is normal so far. While Coral company uses NPV method to evaluate the capital project using a 10% post-tax nominal cost of capital. So we have the discount factor here. Its directors feel that NPV is only an indicative amount of wealth creation and that the NPV method has certain limitations. Okay, yes. The volatility in the market may influence the NPV, correct? She has therefore asked for sensitivity analysis of this project. So probably next question could be about sensitivity analysis to understand the possible impact of these uncertainty. Okay, fine. So all the information we have till here is all about the NPV project, and we have seen the numbers and data over here. It's very straightforward what we generally see in our practice questions. So we're going to do the same thing over here. We're going to create the NPV structure, NPV calculation. What is the NPV structure? We're going to utilize this left side for our particulars, we can say, like the titles. We're going to have how much time period we have: T0, T1, T2, T3, and T4. We'll not have anyways T5 and all because it's only this much. We're going to use the sales unit at the top because you have to multiply everything. So in first year it's 120, next year it's 135, after that it's 160, and we have 100 over here. Now, what were the numbers we had? We had sales, we had variable cost, then we had fixed cost. Then based on the title, we are going to get over here the cash flows before tax, or we can call it pre-tax cash flows. Pre-tax cash flows. Then we are going to write the tax figure over here. Then we can write the TAD over here. Then we'll basically get the post-tax cash flows. Then we'll have the initial investment over here. They told that we won't have any scrap value, so that's anyway zero. Don't have any working capital information over here, that is also zero. That means when we sum up all of this, we can get the net cash flow over here. Then we have the discount factor, that's 10 percentage. Either we can use our regular traditional method of finding the present value and adding up together, or because we have an NPV, we have the Excel sheet, we can use the NPV formula to get the answer. We'll anyways try out both and see. Let's see if we can get the same answer for both. All right, so let's start doing the calculation. First thing is, first we can get the sales price per unit. Then that answer we can multiply with the sales unit, or else everything will get messed up together. So $35 is the uh, current sales price. So that will be equal to 35 is over here in T0, and it's growing by 35 multiplied by, it's growing by 1.06. Okay, so 37.1 is the answer. Then what we are going to do is previous sale multiplied by 1.06, we'll get the next one. And if I multiply with all of this, we get the sales price for each unit. Next, what we will do is we need the units also. I mean, this is per unit. We need the total figure. What we can do is this answer. Oh, then the cell will not work. We'll do one thing, we'll do manually, or else it will get confusing altogether. So this will be equal to 37.1 multiplied by 1.06. These answers won't change because we had the formula, but then if I multiply with the units, everything probably will get messed up. So what is the answer over here? 39.326. And what is the answer over here? Instead of this thing, we can take 41.68556. Now what we are going to do, we are going to multiply each of this with the total units. So into 120. So this one into 135. This one into 160. And this one into 100. So we have all the total sales figure over here. Next thing, we need the total variable cost in the same way. What is the initial variable cost? 23 per unit, and it will increase by 4 percentage. So minus equals to negative 23 into 1.04 into 1.04, right? Yeah, into 1.04. Then it is equal to minus 23.92 into 1.04 equals to negative 24.8768 into 1.04 and equals to negative 25.8719 into 1.04. So we have found the variable cost per unit. Each of this now we're going to multiply with the total units, that's 120, and the next one we're going to multiply with 135. The next one we're going to multiply with 160, and the next one we're going to multiply with 100. Then we have fixed cost, which does not have any inflation, but it's directly given to us, equals to 750 in the first year, and second year also they told the same thing. After that, it's 800 in the third year and 800 in the fourth year. So the pre-tax cash flows are going to be equal to the sum of these numbers. And if I take the total over here, we have the total pre-tax cash flow. Tax rate, they told in the question, where is tax rate? This is tax allowable depreciation. Where is tax rate? Do we have tax rate anywhere? Yeah, Coral Co pays tax rate at 25%. So tax rate will be equal to negative this one into 0.25. And if I copy paste that formula for all the cells, we get the tax. We need TAD. What is TAD? TAD is allowable at 25% reducing balance method. Generally, TAD will be available on what? On the initial investment. So let's just use the bottom over here for TAD calculation. What is the general format? We have 3000, and it's going to decrease by 25% every year. So this into 25% is this one. First year opening value minus depreciation, we get the second year opening value. Then this figure into 25 percentage will be this one, depreciation for second year. This one minus this one, we get the third year opening. So first year depreciation is done, second year depreciation is done. We need to depreciate one more year, so that will be equal to this into 25 percentage. And if I minus out, I'll get the opening balance for the fourth year. But fourth year, I'm not going to depreciate. Rather, they told that I can claim a balancing allowance, because in last year they told there is a zero realizable value, which means at the end of fourth year, I'll have a scrap value of zero. This is depreciation 1, depreciation 2, depreciation 3. And the last drop in value will be equal to that whole value will drop down, because it will go to zero. So I got all the reduction, all the depreciation figures. Next thing what I have to do, these figures I have to multiply at tax rate. Depreciation into tax rate is called the TAD, the benefit. So depreciation multiplied by 25% tax rate, copy it for the second year, copy it for the third year, copy it for the fourth year. So now we got all the TAD figures. What do we have to do? We have to write it as the positive amount over here. So T1, T2, T3 over here, and T4 over here. Just keep in mind, if in case this was an arrear tax, then these two columns will just go forward by 1 year. Okay, so it will start from T2 and it will go all the way till T5. So be careful whenever it's an arrear question. Initial investment is minus 3000 in the first year. I mean, sorry, in T0. So we can get the net cash flows over here by summing up all the numbers, but be careful, don't sum up all the way till top, because because we're going to copy the formula. What will happen is, let's say I'll just show this. If in case I copy all the way till up, and if I copy it over here, now what happens? This number is now the sum total from all the way up till here, but we already took the sum total in between over here. This was already the sum total of numbers over here. So if I add it up with this number, it will get double multiplied. I mean, sorry, double added. So what I'll have to do, I'll not have to take all the way till up here. Rather, I have to count from here to down. So what I'll do, I'll just rearrange this formula over here. I'm going to reduce it from this pre-tax cash flows onwards till whatever is coming up after that. Then copy paste it for all of this. So now we can see the numbers have gone down. So this is the total of this one, this is the total of this one, this is the total of this one, this is the total of this one. So these are the net cash flows we have before discounting. First, let's go with the traditional method and see what answer we get. First is, this will be 1, and then the discount factor for each year, I'm going to write here discount factor 10%. So discount factor of previous year divided by 1.10, then copy paste it for all the years, we get the discount factors, then the present value that's equal to the net cash flow into discount factor, then multiply all of this. Then we are going to find the NPV, that will be equal to total of sum of all the present values over here, and we have the NPV over here. Cool. So what we did, we just copy pasted. Always be careful, or not careful as such, because your NPV is going to be on the Excel. When you're doing, also don't practice on notebooks by with the pen and paper. Always practice on the Excel sheet itself. These few formulas, and it's just one formula. It's just the copy paste formula that we are utilizing, but that can save you hell lot of time in the exam. So be very prepared. Master that particular technique of copy pasting the formulas. You can be really quick in scoring a lot of marks here. Okay, many people still go to the discount factor table to get these discount factors and all. For section C, don't use the discount factor. Go with the simple formulas and always get the answer. If you want to go with the discount factor table, it's always fine. You have the formula sheet over here, and I believe it's this one. No, not this one. Formula sheet is this one. Where's discount factor table? Yeah, it's over here. So you can get the numbers over here, but you have seen over here, now we have not opened that thing itself till now. We still solve the whole thing, which means you can go with the calculation, and within a snap you can, not even a second or maybe not even 2 seconds, you can finish all this thing within snaps. Okay, so know how to do these calculations and all really fast. Now let's just simply try. I'm not a fan of doing this formula, Excel formula to get the NPV, because I mostly forget this thing because I have to remember that formula. It's a new stuff. So let's see what is the formula. It's NPV. Then I have to write the percentage. That's 10 percentage, comma. Then I have to take the cash flows from. I should not take the present value. I should take the original net cash flows. So I have to take it from T1 to the last year. So that will be these years. Then I have to separately remove the initial investment. So that will be this one, T0. Now there's some issues with the bracket over here, 10 percentage, and I think I have to close this thing, 10 percentage. What is the answer we're getting? 343, 543. Okay. So either with the formula or the other ways, we're getting the same answer. So you basically can just skip this part and you can directly get over here. So anyways, whatever is comfortable to you, you can do that. In the exam, both are allowed, so it's totally fine. Now are we done? Generally what people do, okay, we got NPV, khalas, let's go to next question. But we have conjunction. If in case you don't comment it, you will easily lose that 1 to 2 marks, whatever is sorted for that. Cool. So don't ever forget to comment it. Just make it a habit. Once NPV is done, you have to comment it. If they have asked also, if they don't ask also, just do the commenting part. So what we have to do, comment on whether the project is financially acceptable. Did we get a positive NPV? Yes. So is it financially acceptable? Yes. Just to get some gap over here, I'm just going to pull this down. So what is the financial acceptability? NPV theoretically states that when projects are positive NPV, it must be accepted. Hence, as this project has a positive NPV, the project is financially acceptable. One negative point, what we can write? General NPV point. Most figures in NPV is based on assumptions. For example, the constant inflation rates. So what we have to do, hence, conducting a sensitivity analysis can be helpful to identify the critical variables in the project. Always use this as the conclusion for NPV. Not that you're going to get a lot of extra marks because of that, but just to stay professional, just to write the positive and negative part. So hope this 8 marks is clear for you. Now we have 12 more marks to score from this question. Let's move to the next one. Briefly explain the term sensitivity within the context of investment appraisal and the method of calculating it. Okay, this is asking how to calculate and what does it mean. Just 2 marks. So we're just going to give 1 mark and 1 mark. That's it. So what is briefly? Briefly means in 1 mark you have to explain. What is sensitivity analysis? Sensitivity analysis is a calculation method to incorporate risk and uncertainty into investment appraisal. In the calculation, what do? We calculate and find out the critical variables within the NPV analysis so that management can focus on it when proceeding with the investment. Uh, Sensitivity analysis helps in finding out the degree of change required in a variable to make NPV 0. How to calculate it? The formula to calculate sensitivity analysis is NPV of project divided by NPV of variable. What else? Higher the percentage of sensitivity, higher the percentage of sensitivity, lower it is low, less critical. This for the variable. Cool. So that is it for 2 marks. Then explain and calculate sensitivity of the project to change in selling price and change in discounting rate. Okay. Explain and calculate. So number work alone isn't enough. Next thing, selling price and change in discount rate. So two calculations we have to do. So C part, we have to calculate sensitivity analysis. Now we're going to do for selling price. What first we can do is just take the NPV of project. What was it? NPV of project was 343. Okay. NPV of project is this one, 343. Okay. Now we have to take the sales price. Oh, I have to calculate this all over again. Like I'm not able to copy paste from the other one, so let's do it again. What were the units we had? Units were 120, 135, 160 and 100. Sales price would be equal to 35 into 1.06 multiplied by 120. No, in 35 into 1.06, then 37.1 into 1.06, then 39.326 into 1.06, then 41.68556 into 1.06. Now we're going to multiply each of this into the unit, into unit, into unit, and into unit. Now we got the total sales price. Next, what we have to do, find the present value of sales price. But since sales is attracting some tax, I need to find out what is the post tax sales price. So I have to minus out 25 percentage, which means I have to take 75 percentage of each of this. So we got 75% of each of it. Next, we take the discount factor of 10% and find out the present value. We'll have 1 divided 1 divided by 1.10, and if I copy paste for all the years, I'll get this. Then if I find the present value, will be equal to this one into this one. Then if I copy paste for all the years, I'll get this. Then if I take the NPV, I'll just have to do the sum of all these numbers and we get the NPV of sales. Next thing what I have to do? I have to do the analysis, sensitivity. What is the sensitivity analysis formula? NPV of the project divided by NPV of the variable. That is equal to 0.02, that is equal to 2.7777, which means 2.78 percentage. We have calculated. What we have to do? We have to explain. If I don't explain, I'm not getting marks. So what I have to do? I have to write a comment over here. What does 2.78% of sales price mean? Does it mean that sales price, if it increases by 2.78%, something will happen? No. If the sales price falls down by 2.78 percentage, my NPV will become 0. This is what it means. So I'm just going to write the statement over here. This means that a fall in sales price by 2.78 percentage would cause my NPV to become 0. So we have explained. That's enough. Next thing we have to do, and change in discount rate. Discount rate has a specific way of calculation, that is, you have current discount factor. What is current discount factor? 10 percentage, or we can also call it as the WACC. Then what we find out is we'll find the IRR rate. What is IRR rate? IRR rate means the rate at which NPV becomes 0. Rate at which NPV becomes 0. So when we get IRR, is that the answer? No. IRR is the rate at which NPV becomes 0. What we need to find is from WACC, what is the change that is required to reach that discount factor so that NPV will become 0. That's called sensitivity. So I have to find out what will be the difference. How will I find IRR? If we go by the long method, we'll take the cash flows, the net cash flows from the other table. Then we will have to take 10%. We got a positive NPV, so we're going to take a higher rate, then find a negative NPV, then we apply the IRR formula, get the answer. Or second, we have the shortcut, we can use the Excel formula. So we'll do both of it and see if you're getting the same answer. For that, now I have to find out what is this net cash flows from that other table. Since I'm not able to copy paste from that table due to some reason, let's try once again if you are able to copy or not. So we are currently in question number this is 36, 35, 34. So it is over here. We have this net cash flows. Let's try copying it once. Control C. Control V. No, it's not working. So we'll do one thing. We'll just let's see if it works on the scratch pad or something. That is also not working. So what we can do is we can just write these numbers over there. Minus 3811.2. How will I remember this thing? Okay, we can just write over here. Minus 3000 minus 3000, then 811.2, then 1041.107, then 1403.111, then 1012.4. So we have the numbers. Let's go to alright. So net cash flows are here. What were the numbers? minus 3000, then 811.2, 1041.107, 1403.111, 1012.4. So we have the numbers over here. What will be the lengthy method? We're going to take a discount factor, something higher. Let's go with 20 percentage. So here it will be 1, here it will be 1 divided by 1.2. Then I'll copy paste this for the entire year. Then I'll find the present value that will be equal to this one into this one. And I'm going to do the copy paste for all of this. Then I'm going to find the NPV over here. That'll be equal to the sum of these numbers. So now we have a negative NPV over here. We have a higher rate over here. What was the low rate? Low rate was 10 percentage, and the NPV at the low rate was 343, right? 343. So what is the formula for IRR? The IRR formula is lower rate plus, open bracket, numerator will be NL divided by denominator will be NL minus H, and all of this multiplied by H minus L. This is the formula. Now let's try applying this formula. I wrote low over here. Let's just remove this percentage for ease of calculation. 343. Okay, NPV at high rate. Then H will be equal to 20 and NPV at high rate will be equal to minus 300. Okay. So I just removed the decimals. I'm just going with the whole numbers. Now let's try this. Lower rate plus, open bracket, numerator will be NPV at lower rate divided by, open bracket, NL minus NH. NL means NPV at lower rate minus NPV at higher rate, close bracket. Now we have the denominator in one close, multiplied by, bracket open, H minus L. What is H? 20. What is L? 10. Bracket close. Now that we have under one bracket, all of this inside another bracket, and I add it with the low rate. What do I get as the answer? 15.33 percentage. So because I removed the decimals, some small minor change could be there, but that's totally fine. This is a section C question. It's human marked, so the examiner is definitely going to see your workings and everything. So that is totally fine. This is, we can assume that this is 15.3% or 15% or slightly higher than this. Whatever answer we have, we'll utilize this. Let's just quickly calculate what it would be with the formula. How we have to apply the formula is, we take the net cash flows over here. We have the discount factor over here. Now assume that discount factor is anyways a assumed number, so it doesn't matter. So what we can do is, the IRR formula goes like this. IRR, open bracket, take all the cash flows before present value, meaning the original net cash flows, comma, then apply some random percentage which is greater than your original WAC. So original WAC was 10 percentage. Let's apply this 20% randomly over here, close bracket. What answer we get? 14.9 percentage. So that's somewhere close to 15.3. So there could be slight differences. Why that slight difference is there? Firstly, because I'm using a formula. Second thing is, here I took cash flows with all the decimals, and here I calculated without the decimals. So that also could have contributed to this thing. But in the end, your answer will be somewhere very close to each other. Now also it's very close, but as I told, the reason for difference. So hope you understood the format. Now let's just try simply another number. Let's use simply 30% and see what's the answer. 14.9. Let's use 15 percentage. What's the answer? 14.9. Let's use 10 percentage. What's the answer? 14.9. Let's use 5 percentage. What's the answer? 14.9. So whatever. So it's, I think it's any random percentage. Doesn't have to be greater than WAC. Anything you're using, you're still getting the same answer. So I think we can go with this answer because this was a rounded off figure. Let's not consider this thing. I'll just mark it red color so you don't focus on this thing. We'll just focus with this IRR rate itself, that is 14.9069, which we can round it off to 15 percentage. So now what is our conclusion over here? Is that the final answer? No. WACC is 10 percentage, which is your existing cost of capital. IRR is 15 percentage, at which your NPV will become zero. So what I need to know is, what is the difference over here from 10 percentage? What change is required to reach to 15 percentage? Percentage change in discount factor. How do I get that? I have to apply the formula new percentage minus old percentage divided by old percentage. What kind of a format that is? New percentage means 15 minus old percentage means 10 divided by 10. This is just a way that I remember it. That's not the exact formula or anything. That formula I learned, this new minus old thing, I learned it, I think, back when I was learning business valuation chapter. In business valuation chapter, we learn this thing called share price movement. So how do we find share price movement? New share price minus the old share price divided by old share price. So I learned this thing new minus old by old back then when I was doing business valuation. So I apply the same logic for anything when I want to find a percentage change between two numbers. Okay. So this is how we find the difference. So what is 0.5? That's 50 percentage. Calculation is done. Yes. Solution is done. No. Because conjunction always important. Calculation is done. What is this? Explain. So what does 50% mean? Does it mean discount factor should drop by 50 percentage for NPV to become zero? No. Discount factor should go up by 50% to for this to become zero. So discount factor should rise by 50 percentage for NPV to become zero. Now for discount factor, we found it's 50% sensitivity, while for, I'll just mark this in a separate color so that we know this is our solution. Okay. So discount factor, we found it's 50 percentage, while for sales price it is 2.78 percentage. So which one is highly sensitive over here? Remember in the previous question we told over here, higher the percentage, less critical it is. Which means over here, discount factor is 50 percentage. Higher the percentage, less critical it is. So on comparison between discount factor and sales price, discount factor is less critical variable to this project because it has a higher sensitivity percentage than WAC, than sales price. So that is our final conclusion, and with this we are done with this particular question. Are we done with this thing? No, we are at 36th question, so we have 37th question. That will be the end to our section C. So let's move to this final one. Okay, discuss why discounted cash flow investment appraisal methods are superior to non-discounted cash flow method. It is 6 marks. If you can get 6 points, then well and good. If not, you'll have to use maybe 3 to 4 points, but elaborate it sufficiently enough so you get maybe around 1.5 marks for each point. So so this is how our rough calculation would be. But yes, you have to explain the methods, and that's a total theory question, so we don't need the case study. Let's start framing this. Say pure theoretical question. If you have done the exam kit, you must have seen the same question over there. So if you know the concepts from there, apply it. If you don't know how you can brainstorm the ideas, just think like this. The most superior king of our investment appraisal techniques is NPV. Just see why NPV is better than the other ones and start building your points. How NPV is better than the other ones? What are the other techniques we have? We have IRR, we have payback, we have ROC, then we have NPV. So NPV is the main one. So we have four major investment appraisal methods. Okay. First thing, why NPV is better than ROC. ROC is profit based method. NPV is cash flow based method. But don't tell that NPV is this thing and this thing. Just talk from the point that discounted cash flow method is so and so way. Okay. So that we get the answers accurately according to that. So we're just modifying it. As I said, this is just a brainstorming idea. We're going to erase this once we're done. So first we can tell that NPV is greater than ROC because cash flow based method. So cash flow based calculation. Discounted cash flows, discounted cash flow methods are on the basis of cash flows, unlike profits. One liner we told. What is the problem with using profits? Profits are based on accounting rules and and for the same company with different accounting methods used, different profit figure can be found out. Hence the analysis, hence the appraisal method or appraisal solution varies. Accounting profits can be manipulative using creative accounting method, while cash flows can't be manipulated with different accounting methods. So we told why cash flows are better than profits, but we didn't use the word NPV or ROCE over here because that was not the question. Question simply asked why discounted cash flow method is greater. So we just used one discounted cash flow method, which is our king, and we're just comparing this with others. Number two, why is NPV greater than payback period? Generally, NPV is something that what is payback period? Payback period means the investment appraisal method which looks out for safety, meaning it looks out for the project that gives the initial returns quicker so that we hit the break even fast. So it looks at that safety point. But if let's say that project has a time horizon for 10 years and if I get the payback in second year, what happens from T3 to T8 is not T3 to T10 is not considered. But for NPV, we always look at the whole useful life, even if it's going into perpetuity. So, consideration for whole useful life. Now, we're going to expand the point. We don't have to tell that NPV does this, but we can tell that payback does not do this. Okay. So, consideration for whole useful life. Consideration for whole useful life. Okay. Discounted cash flow methods generally considers the whole project's useful life for investment appraisal. Then what? Current cash flow method generally considers the whole project's useful life for investment appraisal. Appraisal methods like payback period only considers until time period where initial investment is returned and a break even point is reached. Whether the project performs better or worse in the long run is not considered is not considered and considered. That's enough. So we told about whole useful life. Next thing, why is NPV greater than IRR method? What was the major drawback with IRR? IRR is also using discounted cash flow method. NPV is also discounted cash flow method. So what you can say, IRR has percentage based answer, meaning no. Yeah, IRR is a percentage that gives NPV when it does become zero, but doesn't give an exact answer to the absolute shareholder wealth generation or anything. But NPV on the other hand gives a final absolute wealth to what? shareholders are generating. So you can give that as an answer. Shareholder wealth creation. Discounted cash flow methods. Now we can say like this: primary objective of um, financial management is shareholder wealth maximization. Discounted cash flow methods generally aligns to this objective by giving by focusing on shareholder wealth creation as its decision making role. I'm not going to compare saying that IRR gives a percentage answer, because as I told earlier, this was only for brainstorming ideas, what points I can use. I'm not going to compare NPV with these things in my answer. I'm going to compare discounted cash flow method with non-discounted cash flow method. So why did I use this? Where is that payback period? Why did I use payback period as an example over here? Because payback period is not a discounted cash flow method. Yes, we have discounted payback method to counter that, but again, the one we used over here is not the discounted payback period. We use the normal payback period. So we used one example of a non-discounted cash flow method to validate our answer. Similarly, I'm going to tell that discounted cash flow method generally aligns to us by focusing on shareholder wealth creation, but I'm not going to pull down IRR as an example for this to validate, because IRR is a discounted cash flow method. So what I'm going to use is I'm going to use payback and ROCE as the answer over here, or like I'm going to use that as the prey over here in order to validate my answer, because those two are non-discounted cash flow method. So understood the idea behind this? Cool. So payback method only focuses on quick returns, and ROCE only focuses on whether the rate of return is greater than target set by the company. Neither of these focusing on long-term shareholder wealth creation. So you understood how we used NPV and IRR as a comparison to build a point, but kept IRR and NPV safe on one side and used payback and ROCE to validate your answer. Cool. So hope that was clear. Next thing what we can say now, since we have compared all of this thing, let's think of something else. Discounted cash flow method, which means we are finding present value, and over here non-discounted cash flow method, which means it's taking the absolute value. What is the reason, or what is the the essence behind using discounting? What is the concept of discounting? The concept of discounting simply means that the money that I get today, let's say if I'm getting $100 today, it's $100 today. But if today I'm saying 5 years later I'll get $100, will I be able to buy the same thing over there? No, I'll be able to buy less thing, which means value of money keeps on dropping as we go in future. So why we consider discounted cash flow method is because we consider time value of money into this and see that incorporating this time value of money, which is a reduction in value over future years, will this project still be feasible or still be financially good for my shareholder? This is what we are incorporating through a discounted cash flow method, which is not done in a non-discounted cash flow method. So let's incorporate this. Time value of money. For time value of money, what we can say? Mm, it is certain that due to various factors in economy, the value of money drops as we move towards future. Discounted cash flow methods consider this time value of money by discounting the cash flows with an appropriate discount factor to reflect this value reduction in future, and find out whether and analyze and find out whether the project will still be financially good for shareholder wealth creation. This time value of money is not considered within non discounted cash flow methods. So, since we gave a big explanation for all the 4 points, we can just assume that it's giving us this 1.5 marks for each. But that might be a little bit risky factor to do. Okay. So, what we can do is we can think of one more point to be on the safer end. Okay. So, we need one more point, fifth point, to conclude our answer. So now we have compared with cash flow based calculation. We consider whole life is done, shareholder wealth is done, time value of money is done. We told earlier about this concept of discount rate somewhere for this time value of money. Now we can just try building on that. Like for example, discounted cash flow based method, when we discount it with different discount rates, we can get the present value at different values. Like if I use a higher discount rate, I can bring down the present value. If I use a smaller discount rate, I can bring up the present value, which means by using different discount rates, one thing I can find different NPV. Okay, different analysis I can get. Second thing I can say with regards to the same discount factor is, if in case I'm finding that okay, this particular project I'm planning to invest, I have maybe 5 6 different investors, I can incorporate their WAC specifically into this project. So what I'm trying to say over here is there's two things. One thing is I can differentiate this discount rate part in order to get different NPVs. Secondly, I can also incorporate the kind of custom investors that I have in the project and then use a discount rate according to that as well. So we can build on this point called discount rate, because non-discounted cash flows anyways doesn't have a concept of discount rate. So we can say over here discount rate. First thing, based on the uncertainties and risk involved with a project, discount rates can be adjusted accordingly to find a higher or lower present value of cash flow that considers okay present value of cash flow for analysis purpose. Moreover, discount rate is generally based on the weighted average cost of capital. Hence, based on the project and kind of finances used for the project, discount rate can incorporate these details as well within the analysis for the analysis of the project, none of which is considered within a non discounted cash flow method. So we're done with 5 good points, and that's enough. 4 was quite enough based on our 1.5 mark calculation, but just for safety, we just wrote one more point. Cool. So we have discussed why this is, and now we can erase this one. That was only for brainstorming. And we have done with our final answer. If you want to do some conclusion, we can just give just a simple liner. Hence, Based on the above points, it can be concluded that discounted cash flow methods are far superior to non discounted cash flow methods. Simply, just for namesake. Cool. So, with that, we are done with our 37th question, which means we are done with our section C. So, our predictable areas are done. Now, we have to move into our unpredictable areas. That is, areas where any syllabus area can come up, any syllabus topic can come up. Just because business, finance, and investment appraisal came in section C doesn't mean that it won't come for section A and B. It will come there also. Plus, you will have the other topics like working capital management was not here, so you can expect it there. Business valuation you can expect it there. Risk management you can expect it there. Generally, based on the trend, business valuation and risk management is a topic that you might see within your section B. Like, generally there's a trend that one question, one case study is based on risk management alone, so we can expect that also over there, but it's not mandatory. Maybe you'll find, maybe you'll not. All right. So with that, we are done with section C and hope all the techniques we use here for brainstorming and how to frame our answer, how to reach to our solution, how much to write, how to write, and all the different techniques we used. I hope everything is clear between the two questions we had in section C. Let us know through the comment sections how these videos have helped you or which part has helped you in your preparation for section C questions. And just like every other video should end, make sure to hit that like, share, comment, subscribe, or whatever buttons are there below, and make sure to share this video to all other FM buddies, whoever is preparing for the exam. Now we have to move to section A and B, so keep watching. See you in the next video.